All right, welcome everyone to, I guess, more or less a nice little coffee with Carl slash overview of where we are strategy-wise with our partner SIA. I welcome today Matt Kim and Phil Argue. I'm going to go ahead and turn it over to Matt to do a brief introduction. The game plan for today will be just to get some highlights on where we are, big picture, broad strokes in the market, and then take a deeper dive into how SIA is looking at the portfolios, how we're managing it, and what our thoughts are and strategies for, as we finish up the rest of the year, and then as we move into 2025. So with that, Matt, I'll go ahead and turn it over to you.
Wonderful. Thank you so much, Carl. Appreciate to be in front of you all and hope this is engaging and helpful for you. We do want to encourage questions, so we'll talk about that. But my name is Matt Kim. I'm one of the senior relationship managers here at SIA, and with me today, I've got Phil Argue, our senior investment and analyst, and we're going to want to just provide you a quick update of what we're seeing going on in the market currently, as well as a brief outlook in what we're seeing for the remainder of the year, as Carl mentioned, and a little bit into 2025. So with that, we do want to be able to engage with you guys. There is a chat box. So if you guys have, if you have any questions, as we progress into it, we're happy to answer those questions along the way, or we'll save them to the end, either way, whichever, depending on how Phil gets rolling here. And if you get some steam, maybe we'll wait till the end. But please go ahead and enter your questions in the chat box, and I'll make sure we get to them at some point during this webinar. So, Phil, all yours.
Cool. Okay, thanks, Matt. Appreciate it. And yes, by all means, I can kind of get on a roll. So if you want to, stop and interrupt me, that's all the better. So no problem there. Let me share my screen here real quick, and we'll get going. All right, let's see here. Okay, so every quarter, our investment team puts together a presentation, which I'm going to walk you through a very abbreviated version of it because a lot of it gets technical. And we try to kind of come up with basically a theme for kind of what's going on in the economy, what's going on in financial markets. And this phrase here at the beginning here is what we kind of settled on. So resilience, the economy has been much stronger than expected, which is great for all of us. However, that resilience has led to some frothiness in markets. Excuse me. And so we'll get into that, what all that means and what we think how that impacts our outlook going forward. So quick little agenda. I'm probably not going to touch on every slide in here, but this give you a sense of what we're going to talk about. First, we'll just recap what's kind of happened over the last year. I think it's actually quite remarkable when you step back and look at it. So we'll do that. We'll start there. We're going to dive a little deeper into the economy. So what's going on underneath the hood of the economy? Where's this resilience coming from? We'll talk about the investment landscape, the amount of froth that's out there. How do we measure it? What does that mean for our decision making? And given that we're 3 weeks away from the election, I put a couple of election related things in here. Nothing that you need to take action on, but things to think about and maybe how to contextualize each candidate's policies with regard to how they may impact the economy. And then we'll talk a little bit about our overall outlook. And I might breeze through some areas and spend a little bit more time on others, depending on if there's any interest in the chat or folks ask questions, whatnot. Okay. So first of all, let's just start with looking at where we were last year and where we've come. So this is looking at a number of key metrics I think that most people are impacted by where we were in 2023, October, versus where we are today. First of all, starting in the top left corner there, I mean, it's been a phenomenal run for U.S. equities, right? We're up, nearly 39% over the last 12 months. It's been a phenomenal run. Bonds, which had a very challenging 2021, 2022, are positive, almost about 11.5%. Home prices are up 3.3%. Gold prices are up 33%. And this comes because we've had this declining level of inflation that's allowed the Federal Reserve to kind of ease off. So inflation now is at 2.4%, if you use the headline inflation number. Last year at this time, it was at 3.7%. So it's come down a fair amount. Actually, let me get a little laser pointer here so you can see where I'm pointing to. So inflation's at 2.4, down 1.3% over the last year. Oil prices and gas prices are down, right? So that's a positive, positive for consumer spending. And then mortgage rates have come down a bit. Still high at 6.4%, but we're moving in the right direction. And then probably most importantly for the economy, we've added almost 2.5 million jobs over the last 12 months, which is pretty remarkable given how much pressure the Federal Reserve was putting on the economy with raising interest rates as much as they did. If we were to go back 12 months ago and say, hey, take a guess at all of these things, where do you think they're going to be in 12 months? Nobody had this on their bingo card. So anyway, I want to start with that just to kind of level set how good it has been over the last 12 months before we get into kind of the inner workings of what's going on and where we think things are headed. So again, starting at sort of the top level of the economy, we'll start with the economy. We'll kind of work from a high level and get into some more nitty gritty things here. GDP growth is the chart on the left. So second quarter GDP is the most recent number we've got, was up 3%. We get a new reading for third quarter next week, probably going to be closer to 3.5%. So GDP growth is trying to accelerate here. On the right-hand side is the Fed funds rate. So we know a couple of weeks ago, the Federal Reserve lowered interest rates by 50 basis points. That's this drop you see on the right-hand side. However, they're still very restrictive in their sort of estimation. So they still feel they're putting downward pressure on the economy. If you look at where their estimate of the neutral rate, where they're not stimulating the economy, they're not restricting it, it's down here at 2.9%. So there's still a long ways to go before the Federal Reserve feels that they are not being restrictive. But we're moving in the right direction. We've got another Fed meeting in a couple of weeks. We've got 2 more meetings before the end of the year. So we'll see what they do at their coming meetings. But net, it's a positive. Given that inflation's down, the Fed can kind of take their foot off the brake pedal a little bit, and hopefully keep this economic cycle humming for much longer. So, okay, that's high level GDP growth. Let's go one step down. I'm gonna apologize, my notifications here. Okay, so job growth. I mentioned almost 2.5 million jobs over the last 12 months. If you look at just last month's payroll report, we're at 250,000 jobs. This is the trend of that going over the last 10 years. You can see we're on this sort of downward trajectory, and we really need the job growth to level off here. And it looks like it's done it the last couple months. So we're starting to see a little reacceleration in job growth, which is really positive. But it's not to the point where it's, concerning like, oh, inflation's picking up or the economy's overheating. We still have job openings that are still trending down. We're still above where we were sort of pre-COVID. So labor market all in all is still showing signs of cooling, but it's not cooling to a point where we're going to get negative job growth yet. And that's probably the most important thing with regard to the labor market is, can we keep positive job growth going? In the last couple months have been a big positive to show that so far we can. Couple of again, a little further into the weeds, a couple of leading indicators that we look at to say, like, okay, is the health of the labor market, is it improving? Is it deteriorating? On the left-hand side, we look at the number of employees that are in temp jobs, right? And it's been in a major decline ever since 2021. And some of this might be structural. People don't work at a temp agency anymore. Maybe they drive for Uber or they're doing DoorDash, or, they've got other gig economy work. But it is still a notable decline in the number of temp workers out there. Also, they tend to be the most highly cyclical segment of the labor market. So they're usually the first ones to get let go when the economy starts to slow. They're usually the first ones to get hired because people need help when the economy bottoms and starts to improve. So we do keep a close eye on it, but we recognize there might be some structural issues with that. On the right-hand side, we're looking at the quits rate. So how many people quit each month particularly in leisure and hospitality. So think restaurants, hotels, travel. And the number of quits is really falling drastically. Now, it could be two ways. Everybody's really happy with their job. They don't need to look for a new one, which is usually not how it works. What usually happens is as the economy weakens, there are fewer better job prospects out there. So people are less likely to quit their current job because the reason most people quit is to go take a better job, right? And so there are some still concerning signs under the hood that doesn't make us think that this upswing in payroll growth necessarily is going to be a durable reacceleration, and we don't need it to be. We just need it to stabilize here. So job growth at 100 to 150,000 jobs a month is a phenomenal place for us to be. And so far we're in that zone, and so we're perfectly comfortable there. As I mentioned on the inflation front, inflation's down. We're down to 2.4%. And there's a number of different measures of inflation. This is the headline CPI, which is probably the one that gets closest to what we actually feel as inflation in the real economy. So we're down to 2.4%, definitely trending in the right direction. The Fed's target is 2%, and they have they've put their foot in the sand and saying, hey, we're gonna get there. So they're gonna continue to be restrictive until we do get there. But we're getting pretty darn close, which is why the Fed is starting to slowly take their foot off the brake and give the economy a little bit more oxygen. On the right-hand side, the really positive thing here is that if we look at wage growth, so wage growth is growing at 3.9%, higher than the 2.4% that we've got for inflation. So we actually have real wage growth, which is a big positive for consumer spending, and really the health of the U.S. consumer. So this is a really good development. If we can get inflation down to 2%, wages stay up, wage growth stays up, that should be a very healthy backdrop for the economy going forward. Okay. So one of the areas that we watch closely, particularly over the last 24, 36 months, you've probably heard more than you want to hear about these Bidenomics or whatnot, since it's an election year. But Bidenomics really refers to the several spending programs that the administration put in place, particularly the CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act. And what they stimulated, we basically were giving out grants to companies and organizations to rebuild manufacturing and infrastructure here in the United States. And what it did, it provided a huge boost in construction spending across the country. And construction spending is what we're looking at in the top left corner up here. The blue line is residential construction. So think of homes, apartment buildings, condos. The gray line is non-residential. So office buildings, airports, strip malls, things of that sort. So just to give some context, at the beginning of the year, construction spending was growing at about 10% year over year. Okay. However, over the last few months, we've seen a material slowdown in construction activity. Okay. And to put some sort of context on this, if we took the growth in number of housing units that are under construction over the last 3 months and sort of annualized it, we're on a run rate to contract the number of homes under construction by almost 20%. Okay. Now, so we're seeing a slowdown in spending. Why we care about this, though, is when it comes to construction payroll. So there's about 8.3 million people that work in the construction industry through varying components. Most of them are contractors, right? It's an electrician, a roofer, your general contractor. But typically construction payrolls are a great leading indicator to where the overall job market is going to go. And what we really care about is the overall job market, and construction payrolls tends to give us a early indication as to where the overall economy is going. Importantly, even though we're seeing a decline in spending, construction spending, and a decline in housing units under construction, construction payrolls are still growing. So this may be, some bad memories of 2021, 2022, when There were labor shortages. Companies couldn't get enough people to do the jobs that they needed. So companies are reluctant to let people go, which is good. So let me give you just a historical context of this. I told you that construction payrolls tend to lead overall payrolls. And so the graph that you're looking at is a little different than what you probably would have seen before, maybe. But what we're looking at is the percent change off of an all-time high for different groups of labor. Okay, and so the important one is the blue line. This dark blue line is total private payrolls. So everybody that's working outside of the government. The gray vertical bars here are recessions. Okay, so that's when the economy is contracting. That's usually when bad things happen. And typically at the beginning of a recession, we see a decline in that blue line, right? We see total payrolls declining as we get into a recession. But importantly, what happens prior to recessions is that we start to see weakness in construction areas too. So residential building payrolls is this light gray line. It tends to lead by a pretty significant margin, by about 14 months, overall payrolls, right? And we're not seeing a decline in construction payrolls yet. As I talked about on the prior slide, it's still growing at 3.4%. So even though we're seeing a slowdown in spending, some of these leading indicators within the labor market aren't telling us that we should be concerned that, hey, the coast is pretty clear at this point, although it certainly bears watching because these things do change, can change pretty quickly as we get towards the end of a cycle. Things can tend to change quickly. So couple quick other things on the economy, and then we'll move on to markets, and Carl could keep me honest on time here. But so obviously, everybody's looking at trying to better gauge the health of the economy, whether we're looking at payroll data, we're looking at company earnings. So we decided a couple months ago to look at things through a different lens. And what we actually did is we actually went to the Treasury Department, which is very transparent, by the way, and they provide you every day how much money comes into the government, how much gets spent. And so what you're looking at, the graph here, is the year-over-year change in tax receipts. So how much money is coming into the government? Forget about how much we're spending, because we certainly have a spending problem. But you typically see that tax receipts typically grow at 5 to 10%, on any given year. But there's some oscillation to it, and we tend to see a deceleration in tax receipts as we come into a recession. But right now, tax receipts are really strong, right? We're up about 12% year over year, which would be really unusual for us to experience a downturn in the economy when tax receipts are this strong. And so just by just a level set kind of where tax receipts come from, about 85% of the federal government's income comes from your payroll taxes, right? So tax withholding on W-2 income employees, as well as Medicare and Social Security. Those two make up about 85% of the tax revenue for the Treasury Department. I know there's talk on the campaign trail about corporate taxes. We're going to cut corporate taxes. We're going to raise corporate taxes. Corporate taxes only make up about 10% of Treasury revenues. The changes that they're talking about making, while important from an investment standpoint, and we'll talk about that in a little bit, don't move the needle at all when it comes to overall, the overall health or lack thereof of our fiscal situation. Okay. Forget about just the amount of tax revenues coming in. Left-hand side here is the federal deficit. Whether it's a Republican in office, a Democrat in office, it seems like we're just resigned to running larger and larger deficits. So the deficit right now is at 7% of GDP. We had a monster spending month in August. So on the right-hand side is spending, just the federal government outlays relative to GDP, right? So we're at about 24% of all economic output is produced by the government, which may or may not be surprising. I thought it was higher than I thought it would have been. But so when the government runs a deficit, they are able to stimulate the overall economy because they are, nearly 25% of economic output. So it is an important lever. Regardless of who wins in a couple of weeks, they both have increased deficits as part of their agenda, little different flavors of it. So nobody's talking about balancing the budget, which is probably bad for long-term, America finances with, increasing debt levels, but it can be very stimulative short-term, and markets care about short-term. They care about what's going to happen over the next 12, 18 months. Markets don't care much about 30 years from now, 40 years from now, even though we would like our policymakers to pay attention to that.
Hey,
Okay.
Phil, I have a quick question for you.
Yeah, please.
Like this week we had Phil Tudor Jones come out and say, hey, like we're gonna have to cover this at some point. This deficit is going to continue to get worse, and he's projecting, potential for the market go the other way, just because of the debt issue. How are you guys looking at that? Is that, in his viewpoint, they were going long crypto, long gold as a hedge because of concerns of inflation, and I think you hit on the the lower housing starts. So I mean that obviously can have effects on inflation, and you're starting to see, with all this stimulus the government's doing, how are you guys thinking about that inflation picture and the overall debt? Or is it just more something it's more long term and it's just not in the in the immediate concern?
Yeah, well, so okay, so the big X factor in all of that is when it comes to our debt levels, it really comes down to a question of is the US dollar still a reserve currency, right? Does the globe still consider the dollar the standard? So the big structural question is I don't think that's in jeopardy in our lifetimes, mainly because there's not a better alternative out there. Yes, our finances are on a dangerous trajectory, but we are nowhere near even if you looked at the amount of interest expense that we're spending relative to the size of the economy, we're still below where we were during the second half of the 80s and all of the 90s. So and I wish I had that chart. We had it previously, but I don't have it in here. But so yes, we're spending a lot on interest expense, but if you right size it for the size of the economy, we're not in unprecedented territory. We've been here before. But I think that the big question with, hey, crypto or, is gold going to be, the new thing? Obviously gold has had a phenomenal year. And I think, yes, deficits are going to be supportive of those alternative, currencies. But I think the big picture and the big question is, those other things can be cyclical, right? Crypto is highly cyclical, right? It moves quite a bit. Where those things I think could be interesting and work as a hedge is, does the dollar start to really weaken, not just due to relative exchange rates, but people are worried about the stability of the U.S. government, right? In our debt situation, we are a long ways away from that. However, you get an election comes up, somebody's going to set up policies for the next 4 years. If we kick the can for 4 years, like those problems are going to be bigger. They will. And under either candidate, our problems will be bigger in 4 years. So there's not a fiscally responsible option for us out there, unfortunately. So in the meantime, we have to just manage around, okay, what policies are they proposing? How is that going to impact different parts of the economy? And how do we adapt to that? Obviously, some people, you mentioned Paul Tudor Jones, right? He's making his stance on gold, right? And he's had a great year. Hasn't done as well as the stock market, but pretty darn close. So anyway, Carl, did that kind of answer your question? I know that was kind of
Yeah, that's helpful. Just for laying the framework.
Yeah. Okay. So one other I'm going to apologize for the look of these charts, but let me explain what they are first before we get into the weeds, because I know it looks like spaghetti. But we basically went back and we looked at prior instances where the Federal Reserve cut interest rates going back to 1984, so the last 40 years or so. And on the left-hand side, we've got the Fed funds rate. So what is the path that the Fed funds rate takes? What's the path of the 10-year Treasury takes? The one on the right obviously has got much more of a probably material impact on folks because it moves mortgage rates. So the difference between the red and the blue is whether or not we had a recession in the 2 years following a cut from the Federal Reserve, right? So you can see going across the bottom of these graphs, it's the number of months after the Fed cut rates. The market is expecting, which is this black line, somewhere right in the middle, about 1.75% cuts from their first cut. So they're expecting them to cut a bit more, into next year, kind of late next year. History would tell you if the economy proves resilient, they're going to end up cutting less. If the economy starts to weaken and it looks like we're going into a recession, they're going to cut more. And so the Fed funds rate probably isn't, directly influencing most investor decisions. But on the 10-year over here on the right, this kind of gives us sort of a range of possible outcomes. So again, recessions in red, you typically see the 10-year decline, let's say, 1% or so over the 2 years when we do experience a recession. When we don't experience one, we're up here maybe closer to 100 basis points higher. So 1% up. The one I will excuse this one here because in 1984 we were still coming off of the crazy spike of inflation, and so interest rates were already in a major decline. So I think this is an anomaly that probably we don't want to incorporate. So our range of outcomes are probably more in this range. No recession, maybe the 10-year goes up. Maybe we get back up to 5% or so. We do experience a recession. Maybe they come down, into the threes, below 3. But more importantly, I think what's more interesting, and probably, for most people, equities are a decent portion of their portfolio, and oftentimes what moves it. This is the same analysis, but looking at the stock market over those 7 instances. Okay. So again, blue instances are we don't experience a recession in the 2 years after the Fed cut rates. The red ones are recessions. And if you took these 3 blue lines that are all clustered up here, on average, they come out to 59% over a 2-year period, which is would be, that's not what we're expecting, and I'll explain why in a minute. But if we do get this backdrop where the Fed cuts rates and we don't get a recession, which is kind of panning out here, equity markets can do extremely well. Okay. The 2 that are way down here, again, are 2008 and 2000. So the dot-com bubble bursting. So I think those are out. Those are down there to keep us honest. You can't just say, "Hey, let me just go buy the Magnificent Seven and call it a day for 5 years. Let me go to the beach." There is still some variability in what could happen, and we still got to stay on our toes. And I'll explain why with this. So we talked about the economy, resilient economy, what's driving that. And now let's just talk about this touch of froth. And I'll do air quotes with the touch because it's kind of a relative term. But so the table here, which you're looking at, is a bunch of the major equity indices, both US and international, and 4 different valuation metrics. So price to earnings, forward price to earnings. These are ones you're going to see in articles all the time and whatnot. We also have price to book and then price to sales. So an assortment of different valuation metrics. And then on the right, we looked at the current valuation relative to its own history. So, and we have a sort of a common history here. So PE ratios back to 1998, forward PE ratios in 2003. And as you can see, valuations are high. So a 96 percentile, that means there's only 4% of instances since 2003 where valuations were higher than they are today. And all of those instances were in 2021. So the market has already kind of digested this soft landing sort of narrative and sort of priced for it. Now, it's not something that you need to be concerned about, certainly near term. And let me explain why. So on the left-hand side, so that forward PE ratio that we were just talking about on the S&P 500, if I go back here, so we're looking at this, this number here. If we put this on a graph on this horizontal axis, and what we're comparing here is the 1-year forward return for the S&P 500, that's the vertical axis on this here, relative to the valuation of when we bought the index, okay, across the horizontal axis. So we're at 24.2. Over a 1-year period of time, you can see there's not much of a relationship between forward returns for the market and and valuations. So over a shorter time horizon, in the next year, valuations don't really matter too much. However, when we start to look at longer time periods, the one on the right is the exact same analysis, but now we're looking at 5-year forward returns. And you start to see a better little relationship between valuations and annualized returns for the S&P 500. So this is something to be concerned about longer term, say 3 years, 5 years, 7 years out. Not going to move the needle necessarily on what's happening short term, but I think it's important to be mindful of, because at some point over the next 18, 24 months, we're likely going to get to a point where we're going to need to reevaluate what we're doing in portfolios, because what has been working probably is likely going to change. And so this is a chart that we've shared a number of times, but let me explain what this is, and I'll try and do it quickly. Carl, how am I doing on time, by the way?
Yeah, let's go through that, and then let's talk a little bit more specific about strategy when your guys have.
Okay. So during every economic cycle, one side of the equity market outperforms the other. So this graph, what we're looking at is growth stocks. So the return of growth stocks minus the return of value stocks. This goes all the way back to the 1980s. So during the 80s, it was all value stocks. This line's going down. Value stocks outperformed by 130%. Then you get to the 1990s, growth stocks outperformed by 350%. Then we go to value stocks during the early 2000s. It was 93, in favor of value. So growth stocks have been on an absolute tear ever since 2007. The important thing is these inflection points tend to happen right on the eve of a recession in the U.S. So we don't see a risk of that near term. So we are overweight large cap growth. So we've got exposure in these areas that are doing the best. However, if we get signs that the economic cycle is ending, expect there to be a major leadership change, and likely us changing our positioning as well, to move with that. So the one area of concern is just so many people have just been so anchored to, hey, I just buy Apple, and I own a ton of Apple, or I just own Google, and all these names have done so great, but nothing goes on forever. And it's hard to retrain people after 15 years of, hey, this has been working. So I'm going to fast forward a couple here, Carl, so we'll talk about a little bit more about large versus growth and kind of how we're positioned. So these graphs are looking at last 5 years, looking at a couple of different indices, large stocks versus small stocks. So the Russell 1000, so your Apples, Microsofts, Nvidias, versus your small cap stocks. And large caps have outperformed by about 50% over the last 5 years. So there's been a huge bias towards large cap. We are leaned into that. So we have been participating in that outperformance of large cap versus small caps. We've also seen a similar thing with growth versus value. So growth stocks have outperformed by almost 80% over the last 5 years. We had this huge reversal in 2022. This was interest rates going up. Energy stocks were the star performers at the time. Those are all value names, so this relationship switched. But when the market bottomed back in 22, we've resumed this growth leadership. So we're overweight in growth. We're overweight in large caps. Other interesting relationship, if you looked at U.S. equities relative to international. So left-hand side here is if this line is going up, international is outperforming. International hasn't outperformed for a long time. And we are underweight international equities. So we've got more U.S. equities than our benchmark does. And so you can see international equities continue to just lose ground relative to the U.S. One other interesting point that we oftentimes look at the internal composition of what's leading inside of the stock market to give us a gauge of should we be optimistic, should we be pessimistic. On the right hand side is if we just look at discretionary stocks versus staple stocks. So consumer discretionary, your Nikes, Starbucks, Amazon versus consumer staples, more of your Pepsi's, Johnson Johnson, whatever your Procter and Gamble, whatnot. As this is making new highs here, this is a real positive sign for the market internals. So even though the market is frothy, I think we want to be cognizant of that long term. Internals of the stock market are still very much in favor of these trends continuing for a while longer. So U.S. equities going higher relative to international, growth still outperforming, and we are currently leaned into all of those areas.
Bill, one question there. I guess that
Yeah.
I oftentimes get if the underperformance continues in the international space, what is the driver for really having it, right? It's continued to underperform versus US. One would make the argument, why not just be US centric?
Yeah, and so so Carl, if I went back to this chart, if I were to replace large versus small, or I'm sorry, growth versus value on this analysis, and I did US versus international, the swings are just as violent. So there was going to come a time, again, when, and it's likely on the eve of a downturn in the US economy, you're going to see all of these relationships flip. And so, yes, you go, international stocks have just been, underperforming. I don't think you want to be 100, I don't think you'd ever want to, 100% remove them. So we are underweight, but we're also want to own them because when it does turn, it tends to turn violently. And we'd rather have a little piece of that to catch the swing back. Plus, it's also, I think, just beneficial for diversification and stabilizing, an overall diversified portfolio.
And then, why don't you highlight now, I guess, more specific, because I think we've done a good job of just going through the current outlook. Talk a little bit more granular as to, strategy on your guys' end and how you guys are thinking about portfolios, throughout the rest of the year.
So, yeah, look, I mean, I would say this is largely how we are thinking about things. So these moves that we're looking at in markets, these are things that we are already leaning into and participating. And I know in our platform, a lot of folks have different holdings depending on different customizations, Carl, that you probably set up with. But by and large, we are bullish on the overall economy. We are leaning into those areas that have outperformed. So again, international or underweighting international equities, overweighting large caps, overweighting growth. So if we get a continuation of what's been going on over the last 5 years, by and large, we're gonna continue to outperform. What we are looking at, though, as far as maybe potential things that we're going to that warrant us to maybe make some changes is whether or not inflation reaccelerates. We talked about the jobs. Well, actually, here, let me jump forward, Carl. Let me skip some of these things. Let me go to this guy. So here's how we think this is going to play out, and then some of the signposts that we're looking at that are going to tell us when we need to take action. So currently, we're on this left-hand peach side. We're this big blue box, okay? The economy has been slowing down really ever since 2021 due to the Fed, raising interest rates. They feel they're still restrictive. So even though we've got a little resurgence of growth, we think growth is still going to continue to slow. You want to own the things that have been working well. So, the trend is your friend. You want to own tech, communication services, AI beneficiary names, of which we've got, several in our equity portfolio, and then quality growth. We think you stay here until we get weakness in the labor market or the credit market. Right now, there's no weakness in either one. So we're bullish. You want to stay with it. However, when we get to a point where the labor market starts to weaken and credit starts to falter, given equity valuations as high as they are, there's going to be some rotation, and we will at that time be making some changes in portfolios to preserve the gains that we've realized over the last several years. So we're looking at probably more of an overweight in healthcare, utility names, and staples, things that are minimum volatility. So if there is a drawdown, we're preserving capital, and then ultimately we're looking at, okay, we know that every economic cycle leadership drastically changes. Where is the next cycle going to lead us? And so we're trying to figure out, okay, how do we best navigate this transition? Currently, we're positioned where we should be. Things that have been working as all those areas that I've mentioned, and then we're gonna, when the time comes, try to rein in some of our exposure to some of these areas, mix in some more defensives when the time comes, and then ultimately look at things like emerging markets, international areas that have been, out of favor for the last 10 years, because history tells us, the real opportunity is going to be in those areas that are different or that have underperformed over the last 10 years. I don't know. So Carl, does that kind of give you a sense of how we're thinking about things?
Yeah, for sure. Or I think it would be helpful too is maybe just go through if there are any, concerns that you guys have for the market. I mean, I imagine inflation being potentially one, but maybe just pinpoint some areas where we would want to be a little more defensive, under higher interest rates, or just, I think that's the question I often have times is, hey, the market's up so much, it's got to go down. So maybe go through just how you guys are thinking about that.
Yeah. Okay. Well, so the things that we are concerned about, they are really focused on, what impacts the labor market. And look, if somebody's trying to gauge the next, hey, when is the market going to have another 8% or 10% correction? I would argue that you're going to lose more trying to anticipate a 10% correction than you're going to lose through the actual correction itself. So don't try and, near term, yes, the market is stretched. We've got a number of kind of short-term sentiment gauges that are telling us that, yeah, the risk of a 5 to 10% correction is elevated right now. But that's not a correction we try to position around. That's one where we manage our expectations and know, okay, hey, if we see a 5% correction, it's just sentiment. It's just normal ebb and flow. Bigger picture, what really matters is, does the labor market in the US stay strong? And we're tracking probably 40 different underlying measures of the labor market. I shared a couple of them with you. Everything seems okay for now. Certainly much better after the last 2 job reports. But we're not convinced that we're turning the corner. A couple things that I would say that are things that we're watching for, that we're not taking action, but things that are on our radar screen. Obviously, with the election, one, don't make any decisions based on the election. That doesn't matter. What matters is the policies that these folks put in place. Once they come into office, they put their cabinets in place and start making some of these policy changes. Both have pros and cons. And I had a slide on
So if you want to share that one slide, we got a few minutes.
Okay. Yeah, I didn't know if you wanted to. Okay. So here's sort of and this is a work in progress. This is our sort of breakdown as we listen to some of the speeches that come out. We look at their policy plans. Neither one is it's kind of neither one is great on the economy. Now, keep in mind, I know politics is the third rail these days, and we're looking at this strictly through the lens of financial markets and the economy. So not social issues and things of that sort. So Trump has got a tax cuts plan, so corporate tax cuts. I kind of alluded to that earlier, where Harris has got tax hikes on her proposal. The estimates that we've got so far is that Trump tax cuts would add about 7% to S&P earnings. Harris's tax hikes would take about 5% away. Neither of those are probably big enough to say, oh, hey, we've got to, we're going to trim this. S&P earnings are going to be up 7% over the next year, regardless of all of this. So the trend is still higher, but it's something to be aware of. Increased deficit spending. Obviously, if Trump gets in, he is going to extend the tax cuts that he did from his first term. Increased deficit spending is going to be something to watch, combined with tariffs. So he's obviously a big proponent of tariffs. He's talking about using them more forcefully, combined with the deficit spending. We think there's a risk of higher interest rates, higher inflation. However, keep in mind, on the campaign trail, these folks are going to say whatever they can to get the last undecided voter, on their side. When it actually comes to making policy, they're going to have a cabinet of, experienced government officials, hopefully folks from the private sector that can help kind of shape these policies so they're not so severe. But it's not like Harris is the opposite on when it comes to trade policy. Actually, Biden never reversed the tariffs that were in place on China that Trump put in 2018. So Harris has got tax hikes. She's also going to be increasing the deficit, but not by as large of a margin, because she's going to be hiking taxes and letting Trump's 2017 Tax Cut and Jobs Act expire. There's a big question about immigration. Look, immigration, forget about the social aspect of it, just pure economics. More people coming into the country is positive for economic growth. So that's obviously an issue. Regulation is also a big sticking point. Harris has gone out there and kind of campaigned on increased regulation on healthcare, prescription drugs, increased action on antitrust. So you think about these big mega corporations, they're all currently under assault on antitrust laws. So Facebook, Google, Nvidia, Microsoft, they all have a number of antitrust cases against them. Those probably continue to build as headwinds under a Harris administration. But keep in mind, most likely we're going to end up with a blue or red sweep. So if Congress stays either split or opposite of whoever gets in the White House, all of these policies are going to get watered down, because most of them, you got to get them through Congress. So the important thing with our take here is we're trying to assess what these risks maybe look like, and then the path towards those actually being realized. It doesn't matter what happens on election night. It's, fast forward 30, 60 days later, once we understand who is going to be in the administration, they got to go through all their appointments, build their cabinet, and then start setting out their agenda. It won't be until early next year when we actually understand, okay, what kind of tariffs are we talking about? How much, tax cuts are we talking about, or deficit spending? So don't overreact, but understand that there are some big differences in policy, and we're going to have to adapt to those. But I don't think any of this jeopardizes the bull market unless it jeopardizes U.S. jobs. And I don't think any of that is really at risk here unless things really start to go sideways, and we don't see that happening.
Are there any particular areas, just as a highlight, that you would target under the Trump administration versus the Harris, when you're thinking about your investment positioning?
Yeah. So, there are a number of, I've got them on another presentation of sort of baskets, broad baskets of stocks that would benefit under a Trump administration versus Harris. So going back to this, the tax cuts. So if you were to look at tax, how do I phrase this? The taxes as a percentage of earnings, consumer discretionary is the most taxed sector. So if Trump gets in, certainly with a sweep, consumer discretionary likely does extremely well, because they're the most impacted by the tax cuts, right? So they're going to have the biggest tailwind behind them. Obviously, you look back at 2016, small caps did extremely well. Energy was a big outperformer. We've definitely hindered our ability to expand drilling in the U.S. again, I know that's a social issue, but the expectation is that there would be a lot more drilling permits approved under Trump. So energy companies would have the ability to go, drill for new oil and then and extract that, which should be positive for their revenues. So those would be kind of a couple areas that we're thinking about. Under Harris, I think it's largely a continuation of the same, right? This is largely going to be kind of similar to what we've had over the last few years. The one risk, and so in that, I would say, owning the big cap, mega cap names, having exposure to technology, communication services, so Google, Meta, Microsoft, Apple, those big names are likely still big winners. But this is an X factor, is the regulation, because there are a number of antitrust laws that are in, or cases that are in, that are being disputed right now. Google just lost one that's not the end of the world, but an important one. So that would be one area where we'd be concerned. I think with Harris, it's a continuation of the same leadership that we've had so far. Trump probably mixes up what outperforms.
That's perfect. And then as we finish up here, if anyone has any questions they want to send in while we have Phil today, go ahead and, please type it into the chat box now. And then Phil, in the meantime, any other, kind of final points on your end you want to finish up with while we wait questions?
No, I said, well, so look, I mean, I know, look, I mean, things are really good. I mean, things in the economy are really good. So look, we're in this every day trying to game what's going to outperform here, what's going to outperform there. If you could just close your eyes for the next 24 months and don't look at your portfolio, you're probably going to be very, very happy. So don't think that all of these things that we're talking about require you to go make a change. The economy is in great shape. Yes, it's being financed by deficits that we're going to have to face, or our kids are going to have to face some point down the road. But in terms of the performance of your portfolio over the next 12, 18 months, it's unfortunate to say, but your portfolio doesn't care about, what happens 30 years from now. It cares about what happens over the next 12 to 18 months. So, and things look really good. So we're very positive. Try to turn off the news when it comes to, mudslinging from politicians about who's terrible for the economy. Things are good regardless of which politician gets in. It's not going to change it, most likely. Maybe just a little bit on the fringe. So I don't worry about it. And just like I'd say, sit back. It's been a phenomenal year, and next year is probably going to be phenomenal as well. So.
Yeah, thanks, Phil. I think that that certainly can make some of the attendees feel good. I get questions all the time, just about, hey, it's run up so much, when it's going to come back. But I think you really have highlighted the strength in the overall economy, which can really put folks at ease to know that, hey, things are good, things should continue, despite what the politicians are saying. The stock market is a bit decoupled from that. We're looking at different things. So ultimately we're moving in the right direction. Looks like we have one question. Catherine, if you want to send it in, or I can unmute. You can go ahead.
Is that me?
Yep, you're here.
Oh, no, I was just going to say thank you, Phil, for an excellent briefing. Really appreciate it. That's all.
My pleasure.
Yeah.
Yeah, Phil, Matt, thanks so much. We're looking to, moving forward, guys, I'm going to look to try to have, the SIA team each quarter just give us an economic backdrop on the market. So, thanks for everyone attending, and certainly look forward to chatting with you guys each individually after the call, and then certainly with the SIA team. They are here to help. Phil is a phenomenal resource. So is Matt on the team. So, guys, don't hesitate to send questions as needed, and look forward to chatting with each of you guys individually.
Yep, wonderful. Thank you so much for having us, Carl. If anyone does have questions that didn't get answered, please shoot them over to Carl and we'll get them addressed. And of course, I'm always available as well if you have any other specific situations that you want to go through that might be more personal to your situation. So happy to go through them with you as well. So thanks a lot, guys.
All right, thanks. Hope everyone has a wonderful afternoon. Take care.
All right, bye now.
See ya.